Hello and welcome to the Opening the Gates April 2026 UK property market update. For those of you who are loyal watchers of these monthly updates, you'll notice that my office is very empty. I'm just about to have it decorated in readiness of looking to move, which I've been talking about for a very long time. So a lot of what I'm going to be talking about in the market is actually going to be relevant to my own self looking to move in the near future. So let's jump straight into it and go through what's been happening in April. Okay, so to start with, as always, on the April 2026 market update, we're going to be doing an analysis of activity levels. So to start with, for those of you who are new to watching these, we are starting with the left-hand side, which is month on month. Middle column is year on year, and then we've got April versus the 21-26 average. So on the market, aka properties for sale, slightly up month on month, slightly up year on year, and still pretty high compared to recent years, up almost 21.5%. You'll see a variety of different house price indexes saying that stock levels are at a decade, dozen year high. So as I probably say every single time I record one of these, plenty of choice for buyers, lots of competition for sellers. So that's why you need to be very price sensitive when it comes to putting the property on the market. In terms of new listings, slightly down 5% month for month, perhaps some uncertainty over everything that has been going on in the world and rising interest rates. However, still 1.5% up on a year ago, which shows that it is not all doom and gloom. Yes, April might have been a little bit of a slower month last year because it would have been the stamp duty hangover, which you see around any stamp duty deadline. But brilliant news is up 10.2% on the 21-26 average. So there's definitely still plenty of life in the market from sellers wanting to make the move in 2026. Sales agreed numbers down 3.39% month on month. Again, not unsurprising considering all the geopolitical things that are going on in the media at the moment. But sales agreed are only 0.64% down year on year, which says to me there is still plenty of people wanting to make a move, even with higher interest rates, which we will come on to in more detail as we go on. And sales agreed are down almost 5.5% on the 21-26 average. So 5% down is a little bit of a drop there, but it is not a major crash. I would typically say that when you have a more attractive market, you're probably going to see 5 to 10% increase. Less attractive market, 5 to 10% decrease either side. Anything more than that either side in a positive or negative, you then know you're in a real like boom or bust market. So there's certain things that are going to increase or decrease moves, such as interest rates going up or down, or stamp duty holidays, etc. But for new listings and sales agreed, not much in it, to be fair, on that, which is good to see. Price changes up almost 2% month on month and 3.5% year on year. Nothing new there. Sellers keep coming on at too much money. Buyers are not budging on, sorry, buyers are not appetized, if that's the right terminology, by that price. Sellers are then having to come down, which is seen by the 35% increase on the 21-26 April average. Positive news to be a glass half full, withdrawals are down across the board significantly, which suggests to me that sellers are committed to the market, they're committed to moving, and they are altering their asking price, realigning their strategy rather than just going, do you know what, I can't get what I want, I'll just come off the market. So that's a real positive to see there. In terms of fall throughs, slightly up year on year, so bit of fragility in the market if buyers or sellers are a bit uneasy about something, survey issues, incomplete chains, everything going on with interest rates. That's why I've said every time I'm a big fan of reservation agreements. Interesting fact for you if you're not already familiar with it as well. The quicker you sell a property, the more likely it is to actually go through to completion. So the quicker you find a buyer. And then also non-reduced properties are a lot less likely to fall through as well. So all the data points towards you're more likely to sell in a quicker time, get more money, and for it to actually go through. Relisted, interestingly, is up month on month, just over 22%, which suggests there are some sellers who have tried the market before who are coming back. They maybe withdrew because of the budget last year and have decided, you know what, there's always something going on in the world. Let's just crack on with it. It is down 39.5% though, year on year. And maybe that's to do with a lot of sellers sticking on the market for a lot longer. Properties are taking longer to find a buyer, and unsold properties have been on the market for a longer time as well. But across the 21-26 average, up 24.5%. So if you're not targeting those that have withdrawn with other agents, I strongly recommend you do it. If you want to reach out to me about those strategies, happy to help. And then also don't forget those who have been on the market with you previously, go out and target those as well. Right, on to uh, new listings, average asking price. So this is where I'm going to have to stop sharing my screen to find what I need on the other side. So let's go back. So new listing average asking price is 452 compared to last month at 437, and it was 446 a year ago. So very stable there across the month and year. New listing average pounds per square foot, 382 a year ago, 413 now, up on 403 in the March. So a bit of movement there from sellers, perhaps again being a little bit too overzealous and confident in their pricing. Sales agreed average asking price, April last year was 361, currently sits at 361, no movement there, which is what you want to be telling sellers who actually want to get moved. And it's slightly down month on month on the 362 observed in March. Just for clarity, the average asking price of new listings is those newly listed, and the sales agreed is the average asking price of properties that went under offer in the months of April 25, March 26, April 26. That's not what they sold on Land Registry for, because we wouldn't know that for several months down the line. But I'm trying to show you the top of the funnel all the way down to the bottom to give you a really good overview of the whole market, looking at various different resources to give us as much reliable information as possible. And then pounds per square foot on sale agreed up from 341 to 352 on the year, and then month for month it's at 348. So what I wanted to try and share, which was on my other screen, was for the average asking price. So year on year, up 1.36%, month on month, up 3.44%. New listing pounds per square foot, up 8.12% year on year, 2.48% month on month. And sales agreed asking price up 0.08% year on year, down 0.22% month on month. So I'm just having a look at that. And then we have the pounds per square foot, 3.23% up year on year, and then up 1.15% on the month as well. Then what I want to move into is some year-to-date data as well. So I haven't got this on the chart in front of me, but properties for sale year on year. So from Jan 1st all the way to the end of April, properties for sale are up almost 3%, 19.5% versus the year-to-date average. New listings are up 4.21% year on year and 11% versus the average. Sales agreed down just under 2% year on year. Again, looking at the first couple of months of 2025, crazily busy because of the stamp duty rush. And then versus the average down 2.39%. So again, tiny numbers in the grand scheme of things. Price changes are up 1.85% year on year versus last year's to date, and 29.68% versus the 21-26 average. So again, lots of price changes happening in the market. That's not that the market is crashing, it's just buyers and sellers are having to adjust to more choice out there, more competition, interest rates up, down, left, right, centre. Withdrawal numbers down almost 8.5% year on year, and then up 2.54% versus the 21-26 average. Fall throughs down 9%, or 9.3% year on year. Expect that with less sales being agreed, and down 1% versus the average. So again, it's not as if people are withdrawing from sales or purchases left, right, and centre with everything going on. They are committed. And then relistings are down a whopping 51% year on year and 39.3% versus 21-26 average. So sellers are staying on the market for a lot longer. Therefore, there's not sellers changing agents or coming back to market. But I've said this in the past and it did come true. I said keep targeting on market withdrawn properties and you will definitely see results from it further down the line, which definitely have seen to be the case. Year to date numbers as well on asking prices. up 0.47% versus a year ago. Pounds per square foot up 5.5%. So again, sellers are trying a bit too high in their new listings. Sales agreed, asking price down 0.03%, pounds per square foot up 1.46%. So you can see pretty much across the board there, year-to-date data, April data, typically, whether it's asking price, pounds per square foot, sellers are very ambitious, as they always are. And then what's being agreed is down here. So just making sure that the conversations and the realignment between buyers and sellers, having those conversations early, and then that's more likely to get the deal done. Right, on to the next bit of data. So we're now looking at mortgage approvals for house purchases, 12-month and 10-year. So you see very steady across the board. And then 10-year, you'll notice in March 21, obviously everything was crazy. We had a stamp duty holiday coming up, lots of low cost money around, and we had just that crazy time when the markets reopened through COVID, which is why we saw that spike there. You can then see it come down a little bit due to interest rate rises, and then it steadied out again to pre-pandemic point. And then monthly property transactions, obviously March last year was up at 170 odd thousand, hence why it's so high there. And you can see that it's actually been very steady ever since, around 100,000. And then the 10-year average, again, two stamp duty holidays in there. But apart from that, very, very steady movement there. So we'll come back to that in a second. And then inflation did creep up a little bit last month to 3.3%. So in line pretty much with the 12-month average. So I'm just going to stop there again for a second, just to run through. So mortgage approvals, month on month down 1.24%. Sorry, year on year down 1.24%, should I say. Month on month up 1.44%. So moving in the right direction. And that is March mortgage approvals over February. So obviously February wasn't any of the conflicts in the Middle East. Started at the end of Feb going into March, and that's where a lot of the shock was. So it shows people are still looking to buy property, which is good to see. Versus 12-month average, March was up 0.22%. So again, moving in the right direction versus 10-year average, only down 1.21%. Minimal numbers either side there on the pro or plus or negative, should I say. So it's really, really good to see. And then on the transaction numbers, unsurprisingly down a whopping 41% year on year. You read anything in the news talking about that, take it with a pinch of salt. It was a stamp duty holiday. It's been proven multiple times how that has an impact on the market in that specific month, a little bit before it, a little bit after it. Month on month, though, transaction numbers are up 1.62%. So even in the month of March, people were happy to still crack on with their purchases. Versus 12-month average, up almost 11%. So it shows that there is definitely transactions filtering through, which is really, really good to see. Now, however, the 10-year average is down 8%, so slightly down. So in a 50-year average market, we normally see 1.2 million transactions. So if we're down 8%, we're perhaps going to be on course for about 1.1 million transactions this year, which again is not a bad place to be with everything going on. All right. And then the last thing here is the April house price index update. So Rightmove up monthly 0.8%, down annually 0.9%. Zoopla exactly the same, but up 1.3% annually. That has come down a little bit on the annual inflation. Land Registry up on the month at 0.1%, up annually at 1.2%. Nationwide up monthly at 0.4%, annually 3%. Halifax has gone backwards at 0.5% decrease, up 0.8% annually. eServe down, same price at 0.5%, but annually up at 0.9%, and home.co.uk up 0.4% on the month and 0.5% on the year. So as I say, most times all these different indexes are done on different metrics, from asking prices to mortgage data to completed data. Some are cash and mortgage, some are just mortgage. That's why I do these several different indexes to give you an understanding. And what we're seeing here is very, very modest house price growth across the board, which is continually being reported. The likes of Knight Frank have revised their forecast recently because of everything that's been going on in the Middle East. So they dropped it down to, I think, very low single digits for modest house price growth. So that is the start of the update. Moving on now to the different indexes. So we start with the Rightmove House Price Index. So just zooming in on that. So as I said, up 0.8% month on month. Sales agreed down 3%, and that's lower than this time last year. So they've got the average 2-year fixed rate rising from 5.42% from 4.25% before the Iran war. So going to be a few different mortgage things that you'll see in these different reviews. They're all going to be different because of the timing that they come out and which parts of the market they look at, loan to values, things like that. But you'll see a general trend that there was a big shock to interest rates, products being taken off the market, shelf life not being very high. And then you'll see that it kind of has balanced out. But again, I'll go into that in more detail. So new seller asking prices are just shy of 374,000, smaller than the long-term April average of 1.2%. Increased mortgage rates and stiff competition to find a buyer are limiting new seller asking prices this spring. The number of properties for sale, are at an 11-year high for this time of year I've already talked about. So despite the high mortgage rates due to global uncertainty, the housing market has remained surprisingly resilient so far. The latest real-time market snapshot from Rightmove shows that buyer demand for April is only 7% below this time last year, but consistent with the trend of lagging behind 2025. Number of sales agreed is also resilient, currently just 3% behind this time last year, which is really, really good going. In addition, the number of new homes newly coming to market is only 1% behind last year and a whopping 13% higher than 2024. So we've got the unexpected headwinds of mortgage rate rises denting the confidence around 2026. But there are tailwinds keeping the market moving. Buyer affordability has benefited from average earnings up 3.9% last year, outpacing average asking prices, which are down 0.9%. So a typical mover is now able to borrow more due to last year's review of mortgage lending limits. If you read my LinkedIn newsletter update when it is out, I'll go into that in some more detail. So buyer demand has held up strongest in the most mortgage reliant first time buyer sector, down 6%, suggesting that for now, high mortgage rates are not putting off new potential first time buyers from inquiring. And first time buyers are crucial to the property market because obviously they are the start of the chain. And then Rightmove's daily mortgage tracker shows the average 2-year fixed rate has risen to 5.42% from 4.25% before the start of the war. And that has added, on average, £235 to a typical mortgage monthly. So that is the Rightmove data. There's loads more that I can go through, but I'm just going to touch on a couple of bits in here. Just want to touch on this bit here. So mortgage rates remaining elevated due to the war in Iran. It's not a surprise that price growth was proving strongest in parts of the market less exposed to higher borrowing costs, which I've spoken about many times before, Wales, Northern Ireland, Scotland, and the north of the country. And then you've got the top of ladder homes, while sectors more exposed to interest rates are seeing slower momentum. So across Great Britain, Scotland stands out as an example of resilience, as I just touched on. Average prices rising 4% or over 4%. Lower average asking prices and a faster home buying process continue to support growth in the Scottish market. I am wearing an Open Move t-shirt, subtle plug here, but I have got the Open Move launch event in Cardiff this Thursday. So if you're a Welsh agent watching this, please do get in contact about attending. And we are hoping to transform the way that property is bought and sold in England and Wales so that it can be like what they're doing in Scotland. So for most of the market, the combination of rising mortgage rates and number of homes for sale being at its highest level for this time of year for over a decade means that competitive pricing is crucial, which I have already touched on, for sellers looking to attract buyer interest and secure a sale this spring. So this bit here as well, which I'm just going to touch on. So the unexpected headwinds of mortgage rate rises dented the buoyant start to 26 that we've touched on. Tailwinds keeping the market moving. Although yearly wage growth has slowed, average earnings are still up almost 4% annually, outpacing the asking price, which are down 0.9% year on year. So a typical mover is now able to borrow more due to last year's review of the LTI cap. A reminder to lenders about stress testing flexibility by the Financial Conduct Authority. So despite the rate rises usually weighing most heavily on mortgage dependent first time buyers, demand has so far proven resilient in that group, only down 6%. Suggests higher mortgage rates are not putting off many new potential first-time buyers from inquiring, at least for now. The number of sales agreed for April to date so far this year is also showing resilience, currently just 3% behind this time last year. In addition, number of homes newly coming to market is only 1% behind last year and actually 13% higher than 2024, showing that many new sellers are not currently deterred. There's a few points in there that I have reiterated because I think they're important to understand. Yes, things are down a little bit, but when you compare them year on year to a very buoyant start to 2025, and you've got all the stuff that's been thrown at the market from the budget last year to what's been going on in the Middle East, it's doing really, really well and it is incredibly resilient. Right, on to the Zoop House Price Index. So as I already touched on, 1.3% house price inflation year on year. Average days to sell a home, the same as last year. You'll notice across the reviews, they'll say it's pretty much the same or gone up a little bit. Buyer inquiries are down 2% year on year. So if we look at this graph here, or chart, should I say, buyer demand down 2%, new supply to the market 0% is down 4%, but stock levels are still higher at 5%, and the number of sales agreed down 3%. Right, let's scroll down here. So you'll see it here. Let's just concentrate on the UK. You'll notice that time to sell since the conflict started has gone up a little bit, but only a tad. So it just shows that if you price correctly, market correctly, you're going to be selling in a good time. Those that sit on top of the market are just making others' lives easier who price accordingly from the start to actually get sold. So house price inflation holding steady, mostly down on last year. So again, looking at the UK, currently at 1.3%. You can see where it was last year, closer to 1.5% sort of mark. So it shows that whilst house prices are still growing, that growth has slowed down. And if we look at the new 2-year fix and 5-year fixes, we can obviously see they massively spiked in 2022, went down a little bit. We then had the second shock in 23. Then they've steadily worked their way down and they've cracked up a little bit following the war in the Middle East. Again, I will touch on that in more detail as we go through. I did also put out a post on social media following the Bank of England pausing the base rate for the third time this year, just highlighting that whilst it might seem like it's expensive, whilst it's not the only thing to factor in when it comes to mortgages, because there are gilts, yields, swap rates, etc. I think a lot of the public just base their assumption on the price of borrowing money and interest rates based on the Bank of England, because that's what you see in the news. So they're all saying it's expensive. The average is 5.9%, currently sitting at 3.75%. So it's not as high as what people think. Again, if you want to discuss that in more detail with me to understand a bit more about how it works and how you can explain that to buyers and sellers, more than happy to have a chat about that. So the outlook, just want to cap off on a few paragraphs here. Mortgage rates are starting to drift lower after rising sharply in March. Positive to hear, but they're not going to continue dropping down to what we've seen previously in the anomaly years. It's positive news for market activity and reflected in the rebound in buyer inquiries after Easter. What is less clear is how much further average mortgage rates will fall this year and the longer term impact on the cost of living for UK households because of the disruption to global trade. When it comes to interest rates, again, you'll notice my tabs at the top. There's a few screenshots. That's going to show how the price of money has changed. So they still expect sales to hold up through the rest of the year with continued modest growth nationally of 1 to 1.5%. Anyone selling right now, the message is clear. As I already said, well-priced homes are finding buyers. Sellers that have held back on listing homes should seek advice on the strength of local market as trends vary widely locally and across price points. Again, if I link to newsletter, you'll notice there's some information there about how lower end of market number of sales happening there has increased slightly and the higher end of market has reduced. So buyers are still there. They're reducing their budgets accordingly. Again, I'll get into that in some more detail. So for buyers, mortgage rates are lower than they were 6 weeks ago. That'd be nice, wouldn't it? And lenders are competing for business again. Prices are not falling and the best value homes are moving quickly. So on to nationwide. So nationwide annual house price growth up to 3% from the 2.2% observed in March. So up 0.4% month on month. So despite the uncertainty caused by developments in the Middle East and subsequent rise in energy prices, the UK housing market has continued to regain its momentum following a slowdown recorded around the turn of the year. It's somewhat surprising given the indicators of consumer confidence has weakened noticeably. GfK's headline index has fallen to its lowest level since late 23, reflecting households' more pessimistic views of the economic outlook and their own financial positions of the year ahead. Again, I touch on that more in my newsletter. Measured housing market sentiment have also deteriorated. RICS surveyors reported a sharp fall in new bar inquiries in March, taking the index to its weakest reading since 23. This softening is likely to have been influenced by higher market interest rates following the onset of the conflict, alongside a more uncertain backdrop. Now, you'll know from these updates, I'm obviously a big fan of the property market and investing in property. So I'm always a glass half full. I think you're better to be in the market than not in it. I do not include the RICS surveys each month, so I find them incredibly negative. Maybe that's just my perception of surveyors from back in the day of agency. No offense to any surveyors watching this. So I don't include it. So I do take it with a pinch of salt, a bit like the Property Mark reports that come out as well, because it's just surveying some estate agents, I believe, within Property Mark, and it's not giving a big enough picture, in my opinion, of really what is truly going in the market. So I choose the several sources that I believe are the best ones to look at. So why is the market proving so bloody resilient? It's likely being supported by the relative strength of household finances. Household debt is at its lowest level relative to income for around 2 decades. That doesn't get talked about enough. And sizable saving buffers have been built up in recent years, obviously with COVID. And although these have not been evenly distributed across households, housing affordability has been improving steadily in recent years due to a combination of income growth outpacing house price by a wide margin and a modest decline in mortgage rates. So whilst market interest rates have risen in recent months, the impacts on affordability has so far been limited. Yes, swap rates, which underpin fixed rates mortgage pricing, remain well below the highs reached in 2023. They're broadly in line with levels prevailing in late 24, implying only a partial reversal of earlier gains. Really, really good paragraph there to be touching on with buyers and sellers. Yes, it has gone up, but when you compare it to Trustonomics, the Trust Quarting mini budget, double-digit inflation, the second round of spiking interest rates. When you typically look at things, it's normally on a national level rather than international climate that impacts confidence in the market. And again, that is spoken about in my newsletter. So where next? Looking ahead, UK economic growth is likely to be somewhat weaker and inflation higher than previously expected as a result of developments in the Middle East. The ultimate impact will depend critically on the duration of the shock and the policy response. Who's going to know on that? But what we do know is of all the different things that have been going on over the past 15 to 20 years, house prices tend to go up and people still need somewhere to live. And they shouldn't be looking at just the interest rate and the price of the home. It should be, can you afford to live there? Do you want to live there? How long are you going to be there for? Because this isn't just something that you're going to buy and move out of in 5 minutes. So UK economy and housing market, they've proved remarkably resilient. I use that word so much when it comes to these updates. That does provide confidence, and if the latest shock passes relatively quickly and energy prices normalise in the course ahead, any near-term softening in the housing market will also prove short-lived. Just remember in the past half a decade, 15, 20 years, all the things that have been thrown at the property market, and it just still keeps going. It's just worth remembering that. And then just to scroll down here, if you look at a couple of years ago, average nationwide house price was at 262, currently just shy of 279. There's been plenty of growth in prices in the market, and people have got good equity that they're sitting on. In my update, I talked about that there are more houses without mortgages than with mortgages. So there is also that buffer there. But admittedly, there are going to be a few million people coming off some nice interest rates in the next few years, coming off of 5-year fixes, which were obviously before interest rates started spiking. Just going to touch on this as I probably always do each month. House price earning ratio, bang on the 25-year average. So it's actually a better house price earning ratio now than it was during the COVID market. So that's not to be sniffed at either. Right, onto Halifax house price index. So has dropped monthly 0.5%, still up on the quarter 0.4% and annually up 0.8%. So Amanda Bryden at Halifax has said, as a result of these drops, the average property price is now 299.5. so just below the 300 benchmark. That record was set previous month. So pace of annual growth is also eased, slowing to 0.8% from the 1.2% from the previous month, suggests the market has lost some momentum as spring begins. This is always a month behind nationwide, by the way. So it says March on it because when I do these updates at the start of the month, the Halifax index won't come out for another week. So it's always going to be a little bit dated. So just worth bearing in mind. So recent slowdown in the housing market reflects the wide uncertainty regarding conflict in the Middle East. Concerns about higher energy prices have pushed up inflation expectations, which in turn lead to a rise in mortgage rates. Reduces the confidence for interest rates to be cut this year and dampening the initial momentum in the market seen at the start of the year. So we've gone from pricing in a couple of base rate cuts, maybe getting closer to 3%. Then during the conflict, there were pricing in of, I think, 3 interest rate rises. Now we're looking at maybe 1 interest rate rise this year. So it doesn't look like the price of borrowing money is really going to change much this year. Obviously, caveat on that is you never know what is around the corner. So we'll see. So the effect on house prices will largely depend on how long lasting the pressures prove to be and the wider implications for the economy and unemployment. Although unemployment has dropped down a little bit in the latest readings, which again I touch on in my LinkedIn newsletter. Mortgage rates are a key factor for buyers, particularly those getting on a ladder for the first time, already balancing the challenge of saving the deposit with the cost of borrowing. As a result, many are likely to watch movements in mortgage rates closely before making a decision on any home purchase. In this environment, professional advice can play an important role in helping people understand their options and make informed decisions that are right for their individual circumstances. Again, there's such a huge opportunity there for well-informed agents to educate the public. There are plenty of people out there who are not actually aware of exactly what it takes to buy a property or affordability. And there'll be those already in a home who don't realize the equity that they have, and they could maybe utilize that to move again. So make sure you're having these conversations with people. It's really, really important. Again, in my LinkedIn newsletter, I go through different studies, whether it's research, whether it's from Barclays, Mortgage Advice Bureau, and there's maybe another one in there talking about how people would buy a property if they could prove the finances work. This is definitely opportunity. So the recent increase in mortgage rates has been more modest than the sharp rises seen during the mini budget of 22. Further, many households will already be on fixed deals, protecting them from the latest rate rises. Taking all this into account, house prices may prove resilient, even if uncertainty weighs on market activity in the near term. So this is May, the start of May 2026. I will predict by the end of the year, house prices will not really be any different from where they are now, and interest rates won't be any different either. So you can come back to this video at the end of the year and see if I was right. So that is the Halifax House Price Index. On to eServe. They've touched on mortgage activity remaining strong in March, with eServe valuation instructions around a third above the 2025 average, indicating that demand is still present despite slowing prices. Typically, what you find again is a bit of house price growth is not a bad thing in the market. It does actually get more people moving. When prices drop, people tend to push back. When prices are actually going up, that's when they tend to make a move. So positive there. Right, let's zoom in a little bit on this. So housing market remained relatively firm in March, although annual house price growth continues to soften across Great Britain. So their latest house price index has got the GB house price at 327.5, up almost 1% year on year. Short-term measures have a point to weaker momentum with prices down 0.7% over the quarter. That combination of modest annual growth and softer short-term movement suggests a market that remains active but increasingly price sensitive. We've had a pound for every time say price sensitive. Values remain in positive territory year on year. Affordability constraints, driven mainly by the higher mortgage rates and their impact on monthly payments, may limit the scope for further price growth. Buyer demand hasn't disappeared, but behaviour may become more measured over the coming months. Pricing expectations have softened and could increasingly be dictated by borrowing capacity as much as demand. For now, the market appears to be tilting more towards the buyers, with affordability constraints encouraging greater price sensitivity and the possibility of increased negotiation with sellers. Recent activity suggests the market remains active in March, with valuation instructions undertaken by eServe, as we've already said, almost a third above the 2025 average, worth noting that down. That's driven in part by remortgage activity following lender repricing and product withdrawals, rather than improvement in house purchase demand, but still points towards continued market engagement. So the last bit I want to touch on, where am I? this. A more balanced market backdrop. So housing market has slowed with the annual house price growth just below 1%. However, it is still too early to determine how current uncertainty will affect pricing or activity in the coming months. Like I said, I think mortgage approvals will be steady, transactions will be steady, interest rates will be steady, house prices will be steady. That will depend on whether current pressures are temporary or more prolonged, impacting inflation expectations, mortgage pricing, and consumer confidence. Affordability remains stretched compared with the ultra low rate environment seen earlier in the decade, and high mortgage costs continue to weigh on buying power. The position may be more challenging for some households nearing the end of lower rate fixed rate deals, as refinancing at today's mortgage rates could put pressure on monthly budgets. Even so, slower house price growth should not necessarily be taken as a sign of broad-based weakness in itself. In many cases, it reflects the market adjusting to a higher rate environment rather than to widespread distress. So over the last half dozen years, the picture is more balanced. Nominal house prices are about 22% above February 20 levels. Real terms are 6% lower after you factor in inflation. During the same period, wages have risen 35% and real wages by 5%. That suggests the market is entering this period from a stronger position than headline prices alone indicate. And the final bit on eServe, where are we? So the distinction between the nominal, let's scroll that up a little bit, and real house price movement is important. Headline values may make the market appear stronger than it is in real terms. However, much of that nominal increase in house price in recent years has been eroded by the inflation, whilst earning growth has helped households absorb some of the affordability pressures from higher mortgage rates. There are also signs of underlying resilience. Repossession activity in arrears remains low by historical standards over 2025. That's probably because of the stress testing that was put in following what happened in 2008. So distress has not emerged. That's a key factor to consider as well. There's lots of equity giving a buffer for people coming off super low interest rates. I can be an advocate of one of those who came off super low interest rates, buying my first house in 2016 and then having a staggering increase in 2023. Firmer income growth, lower real house prices, and low levels of for sales together demonstrate the current market's ability to adapt to the external pressures. And then finally, the outlook ahead. So mortgage rates will likely remain the constraint on market conditions, especially in high value regions where affordability is most sensitive to borrowing costs. However, current data shows little signs of a sharp decline in demand in the near term. Modest annual growth and weaker short-term movements suggest the market is adjusting to higher rates rather than entering a period of pronounced weakness. The more affordable regions remain resilient, as I've already touched on, and the higher priced southern markets in London are under pressure. Typically is the case in a higher house price to earning ratio. So that regional divergence is likely to persist over the coming months. Overall, the market is best described as slower rather than weaker. I think that is a beautiful way to put it. So definitely be using that. Price growth is moderated. Strong headline growth appears unlikely in the near term. For the lenders, the key factors to monitor will be mortgage affordability, refinancing pressures, and a continued strength of the labour market in supporting household home buying decisions. Right, on to home.co.uk. So they've got a special 20th anniversary edition. I've been using home.co.uk for pretty much my whole estate career. Absolutely love the data that they provide. So if you're not utilizing the free parts of this website, you definitely should. So key headlines from them. Try and zoom out a little bit. There we go. So stock surge. Agents swelled by 31,500 more properties in March. Negative for pricing as demand is on the back foot from rising mortgage rates. So stock levels increasing, demand reducing. That's going to impact on pricing. So only those who are pricing aggressively are going to find a buyer. New instructions are at their highest level since 2008. That's a key stat to know. So the highest in 2008 for March. 1% more than the already bloated March of last year. Prices edge up, but outlook darkens. So up 0.4% in March. Annualized growth remains just at 0.5%. Time on market, flood of new instructions has brought the typical time on market for unsold properties down. However, the mean time for properties on the market remains relatively high, indicating a significant number of properties hanging around for longer, consistent with heightened stock levels. Again, as I've already said, more properties sticking on the market for longer, not withdrawing, not changing agents, and reducing their asking price. So let's scroll down. So hopes for moderate stock levels have been dashed by the steep increase in March. collectively swelled by that 31,500 properties that I said about in England and Wales. That negative development for future pricing since demand is firmly on the back foot due to the rising mortgage rates. The UK property market is in choppy waters. The new sales stock has arrived when we have got the pre-Gulf crisis, and then demand is being strangled by those rising mortgage rates. Now, with the Straits of Hormuz remain effectively closed for normal maritime traffic, and the US Navy has been sent to blockade a blockade. Vast amounts of contradictory claims in the media only add to the uncertainty. Again, there's so much uncertainty out there. Control the controllables is what you want to be saying to buyers and sellers. Can you afford your payments? Are you confident of where you're going to be in the next 12 months, 2 years, 3 years, 5 years, 10 years? Then get on with it and use loads of case studies. We've had people just like them who are a little bit nervous about market conditions. Maybe it was in Brexit and they went, oh, I'm not sure if I should buy and sell. They did it and then look where they are 10 years later. So the knock-on effect of rising energy costs and then inflation means instead of the pre-war rate cut expectations, we now have potential rate rise expectations. The only question is how many rate rises, and that answer depends on how long the strait remains closed. So the fragile ceasefire currently in place, the conflict seems far from resolved, with both parties poles apart in terms of their respective demands. Hence, the straits look set to remain under control of Iran with little or no prospect of shipments or oil or gas in the near future. So faced with rising borrowing costs and rising stock levels, the UK property market is facing a severe headwinds of reduced demand and increased supply. Key to let sellers know that so that they price correctly. Also, that's a great opportunity for buyers to get in whilst others evaporate around them. It's also clear that most of the UK property market is not quite yet adjusted to a new reality that is unfolding. Make sure you are right at the front of this and delivering value, and you will get deals at this. And then the critical insight, the geoeconomic reverberations of war in West Asia are having a devastating effect on financial markets around the world. A period of stagflation is guaranteed. So there's your stock level analysis that we've already touched on. So up 6.7% on the month. Asking prices again have plateaued, but you can see how far they've risen since 2020. We won't go over the regionals. And then time of market analysis, again, you can see it has dropped down there. And then market turnover, you had the boost in COVID, dropped off when we had Trussonomics. And then you can see it's actually that sort of where I'm hovering now. It's very similar to before the pandemic, which really feels where we are in the market right now. So I'm not going to read the 20th anniversary reflections here, but it is worth a read for yourself if you want to look at the index. So UK house price index summary. So this is completed sales in the month of February. It comes out in April. So yes, this is completions prior to the conflict starting. But annual house price growth is at 1.2% and monthly up 0.1% to 268,000. And if you look at that on Land Registry, which hopefully going to do now, it was 230,500 at the start of 2020. And it's now at 267,957. So about £55,000, and I think 25% increase in the market since the start of COVID. Right, on to the last bits from me. So I said I would touch on interest rates. So this is from Money Facts. If you don't subscribe to the daily emails from Money Facts, I strongly recommend you do. Some absolutely brilliant information that I get through from them, particularly around 5 to 5:30 p.m. Monday to Friday on what has happened in the interest rate market. You might see me share those snippets on my Instagram stories to keep the estate agents following me informed. So you can see before the invasion of Ukraine by Russia, where interest rate levels were, that was an anomaly, not the norm. As I said in a social media post recently, the base rate dropped below 2% for the first time in history in January 2009, until it went back up in mid to late 2022. We then had the autumn budget that obviously spiked things even more. double-digit inflation, rising interest rates. I think we peaked at base rate of 5.25. I can't remember how many base rate increases there were in a row. It felt like it was never ending. There was a lot of them. Then things started to calm down. It reduced a little bit. Then it went back up again. And then we've had a couple of years of things steadying, slowly but surely, which has obviously meant more people have come back to market. Then we have had the war in Iran, and you can see the spike on the screen there. So a lot to contend with in the last few years, and that's even after we had the craziness of a worldwide pandemic that was COVID. The last half dozen years have just been utterly crazy. If you had said in January 2020, this is what will happen in the next half dozen years, you would not think that the property market would be in a position it is. It just shows how resilient it is. So the second thing to look at is change in new mortgage costs. This is based on a £250,000 mortgage over 25 years using the Money Facts average mortgage rate. So you can see that it was the September mini budget, which was the biggest catastrophe for the cost of mortgages. And the difference between June 2023, where the base rate increased to 5%. There's not much between that and then what happened with the war in Iran. So as I said earlier, it's typically domestically, if that's a word, is where things have more of an impact than internationally. So yeah, we can see that there has been a big impact, but it's not been as brutal as the mini budget was in September 22. It's just worth bearing that in mind. So in terms of mortgage market analysis, so if we just look at the 2 and 5 year fixed rate, so we had them in mid twos in 2021. So anyone coming off of a 5 year fix in from 21 to now is looking at a roughly 3% increase in the interest rate. And then you can see with things currently at around 5.7, 5.8%, basically you look at that is the drops we had from April 24 through 25 through 2026. Then we got to April and we've obviously had a month worth of increases, which basically has eroded those 2 years of drop in interest rates. But guess what? People are still buying property in April 2024 with interest rates closer to 6% than 5%. So it's worth noting that. So mortgage payment in May 2021 on a 2.57% interest rate, £798 a month, whereas now it'd be £1,161 a month. So you're looking at about an extra £363 a month. I think again that was on a £250,000 mortgage, 25 years, etc., etc. And then if you look at the 2 year rates, it's gone from 1188 to 1175, so a saving of £13 a month. So not much different there. And then this was the close on the 1st of May on Friday at 5.66%. So you'll notice that things have crept down a little bit in the last month. However, if you look at where they were at the end of February before the conflict, they're at 4.89%, the lowest they had been for a couple of years. So we have seen about 0.75% increase in interest rates. Now, what that is going to do in terms of buying power is you've probably seen a 5 to 10% decrease in buying power. So for ease of maths of me explaining this, if someone was looking to buy a property at 300,000, 10% deposit, so £30,000 deposit, borrowing 270,000 prior to the conflict in the Middle East, their budget has now dropped, call it 5 to 10%. We'll go worst case scenario and say 10%. So no longer are they buying at 300, they're buying at 270 within a couple of months. Sellers need to appreciate that. Buyers are still buying, they're just adjusting their budgets. Or if they're sticking at the 300 mark, their mortgage maybe has gone up 100, £150 a month. Therefore, they're looking for top quality property if they're willing to part with their money. And last thing I'm going to share with you, this is another really, really good link to check out. So on the Rightmove website, they have a link which I have saved, bookmarked, favorited, and it updates every day on what's happening with interest rates. So the average 2 year and 5 year, pretty even at 5.2%, down on the week. So you can see that they are slowly moving in the right direction again, but they are up about 0.5% on a year ago. And then the lowest rates, 4.5%, roughly speaking, not much different in a week. And they're up almost, well, an average of 0.75% on the year. So That is the April 2026 UK property market update. Thank you very much for those of you returning to watch these updates. Thank you for those of you who are new to these. I'll be back in early June to report on what's happened in the market in May. And if anyone has any questions or anything they want me to run through, please do give me a shout. Thanks for watching. Take care and goodbye for now.